as investors, we don't know what the price of Woolworths will be in 3 years,
No.
But we know Woolworths will be here in 3 years. So from a lending perspective, if you're happy to invest with them for 3 years on a loan, and you're happy that you've got the investment horizon to invest for 3 years, the predictability of the return is very high. The predictability of the capital return is almost guaranteed. The key risk in fixed income is don't invest in something longer than you think you've got the capacity to own it, and effectively don't invest in fixed income if you've got the expectation of equity-like returns. To me, fixed income is all about giving you predictability to take the risks in parts of your portfolio where you're better rewarded for risk. And that's challenging in today's climate with low yields.
And where these companies, these bigger companies, talk about Woolworths, where they go out to the market and they ask for money to borrow from you, and they might call it a hybrid.
Yep.
And then that might be an asset class that's an enhanced yield, whereas it's not your typical fixed income product, but they've got different levels of their debt structure, which gives you that different confidence of getting your money back.
Absolutely. Typically in markets we refer to that as the capital structure, and depending on the companies, there by and large are 4 layers to most companies' capital structure, and the top of that capital structure is effectively senior. Often it's secured. Then you might move into subordinated debt, and then finally you might move into what's called the hybrid tranche, and then finally equity. All things being equal, every time you move down the capital structure, you get a greater return, but you also rank lower. And so I think that's really important, that in some regards, that investors in fixed income, they get paid their coupons before shareholders get paid their dividend. In the event of companies getting into problem, then shareholders lose their equity before bondholders contribute equity, and it, in essence, works through the capital structure. So stay short, stay at the top of the capital structure. Yes, returns might be a little bit lower, but the predictability of the asset class is in that space.